on the track, boy.
Hello everyone, I am Queenie and welcome back to Hashtag Just Accounting series. Our previous episodes discussed the definition, history and importance, types of accounting, accounting cycle, and the accounting equation. And for this week's video, I will discuss what debit and credit are and the differences between the two. What are the debits and credits? Debits and credits form the basis of the double-entry accounting system of a business. Debits represent money that is paid out of an account, and credits represent money that is paid into an account. The rules of debit and credit in accounting. The term debit refers to the left-hand side and credit refers to the right-hand side of the accounting equation. If the left weighs 75 pounds, the right must also weigh 75 pounds. There could be no instance where the left is heavier than the right and vice versa. If it happens to be a seesaw, it is in a state of equilibrium. The accounting equation E equals L plus OE has developed the rules to be followed in the study of accounting. The equation stands for the normal balances, or increased sides in each accounting element. In other words, the normal balances refer to the increased sides of the accounts, which may either be a debit or a credit. For assets, the increased side is the debit side, while for liabilities and owner's equity, the increased sides are on the credit side. Conversely, the decreased side of an asset is on the credit, while the decreased side of the liabilities and owner's equity is on the debit. To illustrate, when they say debit to increase an asset and credit to decrease an asset. When they say credit to increase a liability and debit to decrease a liability. When they say credit to increase an owner's equity and debit to decrease an owner's equity. The factors that will cause the owner's equity to increase are investment by owner and revenues. The factors that will cause the owner's equity to decrease are withdrawal by owner and expenses. The increase and decrease of an owner's equity accounts are diagrammed as drawing or personal. The reduction of an owner's equity account arising from cash or property withdrawal of an owner is not debited to owner's equity account to effect the decrease but instead debited to drawing account. The debit to drawing account increase the said account with corresponding decrease in owner's equity. When they say debit to increase drawing and credit to decrease drawing. Temporary accounts. Income or revenue. All income earned of the same nature are summarized in this account. When they say credit to increase income and debit to decrease income. Expenses. All expenses incurred of the same nature are summarized in this account. When they say debit to increase expense and credit to decrease expense. To summarize, income and expenses are factors that affect owner's equity. Income increases owner's equity while expenses decrease owner's equity. Owner's equity is increased by a credit to income and is increased by debit to expense. To recapitulate, the developed rules of debit and credit are again restated as follows. The normal balances of assets, liabilities, and owner's equity, and the temporary accounts of owner's equity, which are income and expenses, are further fixed. Always remember to steer the double entry system. For each debit or credit entry, there is always corresponding and equal credit or debit entry. As a result, we may claim that every accounting transaction involves at least one debit and one credit. The total of all transactions and the sum of the debits and credits for each transaction are always equal. And that is the end of this episode. Thank you for watching. Again, I am Queenie. I I hope you learned something about debit and credit from this week's episode. Do not forget to tune in on our next video. Click like, subscribe, and press the bell button to get notified. Up next are the financial statements. See you again next week and have a good day.